The Gulf region and anchor of the primetime news show Connect the World with Becky Anderson, broadcast from our programming headquarters here in Abu Dhabi in the UAE. And it is no exaggeration to say that you join us in a region on a knife edge. The proverbial clock is ticking on a ceasefire deadline, and this hour there is a great deal of anxiety and uncertainty about what happens next. Sources say US Vice President J.D. Vance is expected to travel to Pakistan today to take part in a second round of negotiations, but the situation remains fluid with heated political rhetoric from Washington and from Tehran, which is yet to formally commit to sending a team to Islamabad. President Trump says the ceasefire will end on Wednesday. That is a 24-hour sort of extension from that which was originally advertised, but he says that will not be extended and insists Iran will negotiate, warning of consequences if they don't. Iran wants the immediate release of an Iranian-flagged vessel the US says was attempting to violate the naval blockade. And the head of Iran's judiciary warns the country must be ready for more attacks. And that, folks, is the latest news this hour. Now, the bigger picture, of course, is that this 50-day war in the Middle East has inflicted a severe shock to one of the world's most strategically critical economic corridors, reshaping growth, inflation and financial conditions across the region and beyond. Which countries are most exposed to economic disruption from this war? What policy choices are most critical to weather this shock, to safeguard stability and build resilience in an increasingly volatile and risky environment? That is our focus today. In a moment, Jihad Azour, Director of the Middle East and Central Asia Department at the IMF, will present the key findings from the April 2026 Rio update. We will then bring in our esteemed panelists today for a 20-minute or so discussion on some of the key findings. For that, I'm delighted we're joined by Razia Khan, who is the Chief Economist and Head of Research for Africa and the Middle East at Standard Chartered. And Natasha Kaneva is the Head of Global Commodities Research at JP Morgan. And Nasser Saidi is the President of Nasser Saidi Associates. Thank you all for joining us today. Our panel will be followed by a 15-minute Q&A session with you, the audience. Please use the virtual chat and we will get as many of your questions in as possible. A little bit of housekeeping. This virtual event will be streamed live in English and a recording of this event will be posted on imf.org. Right. Let's crack on. Jihad, the floor is yours.
Becky, thank you very much. Great to see you. I would like to welcome all the other participants at this launch. Also, I would like to thank the IFC, our partner with whom usually we do this event. As you rightly said, this severe crisis and sudden war created a multifaceted shock, a shock that we did not see over the last 5 decades. This is a shock that has at epicenter oil and gas, but expanded beyond geographically, but also affecting several sectors. It's a severe crisis for the Middle East, but also it's a crisis for the world economy that has reverberated throughout several continents, affecting different economies and different sectors. In the next slide, I will try to focus on the impact of the war on the region itself. And I will be happy if there are questions on the impact of the conflict on other parts of the world. If I move to the next session, and I will focus on the shock itself. It's, of course, I don't know if we see the next slide. Yes, thank you very much. Yes, indeed, this one. We see that at the center of the shock is the oil and gas sector. But it's not only about oil and gas. It's a shock that has several channels of impact. It has impacted infrastructure in oil and gas, where we saw more than 12 million barrels a day reaching a sudden stop. Gas, oil, refining products, derivative products are not able to leave the region. and to access different markets. It's also a real sector shock. And if I take tourism as an example, we see a drop compared to last year in most of the countries, especially in the GCC. This shock also had affected the financial stability of the region, where we saw relatively widening of the spreads of several countries, but also a depreciation of currencies in the region. And the one that was most affected is the Egyptian pound. Moving to the next slide. And here, Becky, we see what would be the impact of the shock. Indeed, the high level of uncertainty that still prevail. And in your introduction, you mentioned that we are 50 days after the outbreak of the war, 1 day from the end of the ceasefire, and we don't know what is going to be the outcome. And in our reference scenario, a scenario where in case the war ends by and the hostilities stop by mid of this year, and we have regular recovery out of that, what we could see that the oil price will be higher throughout the year, as the chart on the left side shows us, that in end of April this year, we see at least that the oil price will be higher than previous iterations by $10 the barrel. We see also a contraction in GCC economies. Of course, this is one of the features of this crisis. It's an uneven crisis whereby countries who have similar economies in the same geography could be affected differently. For example, Qatar, because of the destruction of the output on gas, will have the largest downward revision of growth this year. On the other extreme, Oman, because it has the capacity to export, will have the smallest revision. When we look also at the medium term, we see that these scars will last and will last for several years. Moving to the next slide, that shows us that in case this conflict will be more complex to solve, with bigger and larger ramifications, we see that the impact on oil price could be larger. In the adverse scenario, we see even higher level of oil price this year and next. And in a severe case, here we will see oil price that could reach on average, and for a longer period, $130 per barrel. What does it mean? It means that this will have a major impact on the oil important countries, and what is currently a supply side shock will transform into a shock that affects oil important countries in the region. It will have a massive impact on current account, and in certain cases, like in the case of Tunisia or Jordan, the drop is of equivalent 0.8% or 0.5% per annum in terms of decline in current account. For the oil exporting countries, the story becomes here a differentiation between those who can export and those who cannot. And here the winners are those who have the capacity to recover fast and have enough access to the international markets. Therefore, it's a complex case, and longer the war lasts, bigger and deeper the economic impact will be. If we move to the next slide, and in the next slide, we try to see by zooming more specifically on the GCC economies. Of course, GCC economies, it's not only an oil story. It's not only a gas or derivative of oil and gas. It's also a strong real sector. And here, tourism that has been growing over the last decades and becoming one of the main destinations worldwide would be affected. Not only the tourism sector, but also financial services, especially in centers where financial activities are becoming or are already important parts of the economies. On the other extreme, because of the high level of import of goods and services, and mainly food, if the crisis lasts longer, for countries who have been building buffers over the years, it could have an impact on their capacity to import basic commodities. But those countries have built reserves, have built resilience. The issue is for other countries. And if we move to the next slide, we see that other countries will be affected and affected heavily. Several countries import oil and gas from the region. Countries like Pakistan, Egypt, Jordan, or Lebanon have high reliance on oil and gas from the GCC. But it's not only on oil where they will be affected. They will be affected on two important elements. One is remittances. 5% of GDP on average of remittances come from the region. It's a lifeline that during the COVID crisis was one of the main avenue of access to foreign currencies. It also will affect the capital flows. In certain countries like Egypt, it will be mainly FDIs. In others, it will be portfolio flows. Therefore, the impact of the crisis expand beyond GCC countries. It's not only in oil and gas. It is already affecting the whole Middle East, though in different levels, but it's a regional crisis. Moving to the next slide. In the next slide, we see that I would say the group that is the extremely vulnerable one are the low income and fragile and conflict states, states who are facing the challenge of instability. They will be affected by the increase in prices. For those countries, food and energy accounts to a large portion in their expenditure. And also, it's not only a consumption, but also it's an import story, because the majority of the import of those countries come from the GCC, and the main destination of their export goes to the GCC. Therefore, this energy crisis could transform into a food security issue, a crisis that could have a devastating impact on fragile and conflict state. If you add to it increase in price in fertilizers, if the war lasts longer, this will be a major humanitarian challenge for those countries. Moving to the next slide, and as we see in the next slide, we are in this environment, in a situation where policies have to be agile, have to be also very dynamic in trying to understand the nature of the shock. Several countries in the region have resorted in the past to use subsidies. Subsidies is not the best way to provide social protection. There are several other ways where countries can provide direct support that is more effective to reduce impact on the more vulnerable, and also on the fiscal side, a better way to use fiscal resources. And as one of the key ministers of finance in the GCC said last week during the spring meetings, you have to keep your powder dry, and you have to make sure that you have enough ammunition, especially given the high level of uncertainty. The cost of refugee also could become an important element in the fiscal pressure for countries. We see how the refugee problem is impacting Lebanon or Jordan, but also a protracted war, a long-lasting war, could have an impact on capital flows, and therefore countries need to be very vigilant in their financial policies. Next, please, and in the next slide, as we see, the space is narrowing, the policy space is narrowing, and therefore countries need to remain vigilant. Not only countries who are at the epicenter, the GCC, who have buffers and who have also a set of policies in their toolkit that has been effective, helping them during previous crises, especially the COVID one. The issue is for other crises where debt is high, as we see on the left side of the slide, but also those who have, because of the increase in interest rate, high debt service. This is the case of Egypt, Bahrain, Pakistan, Tunisia, Jordan, and others. It's very important to have an active debt management, but also for most of those countries, there are still some room to address the risk of inflation by tightening monetary policy. Those are some of the issues that countries should face. And if we move to the next slide, what we recommend countries in a world of high uncertainty is to be extremely vigilant. On the fiscal, avoiding what we saw in the past in terms of generalized subsidies that are expensive, costly, and with very limited impact. Countries who have buffers, they should use them wisely. Countries who don't have buffers, they need to find savings for the additional spendings that they will deploy. For the oil importers, any measure should be temporary, should be targeted, and should focus on the immediate impact. For the oil exporters, especially who are the winners, who have a windfall, they need to rebuild buffers, especially in this high moment of uncertainty. Monetary policy has to keep targeting lowering inflation, sends the right signals, and here communication is very important. Countries with flexibilities, they should allow the exchange rate to protect the economy, as for example Egypt did and served Egypt well. Countries where they have fixed exchange rate regimes, policy rates need to be maintained in order to preserve the peg, and reserves need also to be maintained and built up. Financial sector also, the risk of scarring could have an impact on certain number of sectors. Therefore, using the toolkit that was used during the COVID crisis will be important. My last slide is to highlight, and moving to the next, that these kind of crises could have long-lasting impact and require from now to start thinking of the day after and also of the medium term that will come. How MENAP countries need to diversify their economies. What does this war tell us about regional economic integration? We saw some examples in the GCC during this crisis, and it's serving them very well. And how countries need to build their resilience to shocks, but also to instability. Those are issues that we will discuss together in the future weeks and months. But the main important issue today is how uncertainty will be removed and how we can charter the course of the recovery and the stabilization in the region. I did not in the presentation address global issues. Global issues are several, and in certain geographies like Asia are severe. We will have another opportunity to discuss that. Thank you very much.
Terrific, Jihad. Thank you very much indeed. All right, let's crack on and open this to our panelists. Razia, Natasha, and Nasser, thank you once again for joining us. Some really important insight there from Jihad. So, Razia, let me start with you. The REO highlights that the economic fallout of the war is highly differentiated. When you look across the region, the MENAP region, right now, what do you make of the picture? And where do you assess the economic pain is likely to linger the longest, and why?
Thank you, Becky. So in the context of the very considerable uncertainty that we still face at this point, we know that where there has been physical damage to infrastructure, physical damage to hydrocarbons production infrastructure, it could take years to recover from that. And we're still getting a sense of just how extensive that damage might be. But I would caution that it's not just about the oil and gas producing segments of the different economies. It's about the growth opportunities that might be foregone as a result of the crisis. Will we see investment recover? The hope is that with the region's vast sovereign wealth fund assets that could be deployed regionally, we could see a boost to domestic demand. We could see a strong rise in investment, hopefully something of a V-shaped recovery. But it's very difficult to predict with any degree of confidence at this point in time. And the risk the region faces not only is the extensive and long-lasting impact of the conflict itself, but also the fact that all of the opportunity that the region so well represented just prior to the crisis, we don't yet have a sense of how much some of that has been lost. There is still a reasonable ground for the belief that the bounce back can be quick, that recovery can be more V-shaped, but there's still a great deal of uncertainty out there.
What do you need to see next to sort of, underscore the confidence that you clearly believe we might have should things, improve relatively quickly? What do you need to see next?
Well, the single most important point at this juncture is the duration of the conflict itself. And this close to the end of the ceasefire, hopes that negotiations will get somewhere. We really have no real steer. Markets are optimistic. We saw the rally as of Friday afternoon very recently, just the week prior to this. That still remains in place. Are markets calling this correctly? Any indication that there can be a more durable ceasefire, perhaps even a durable peace, will definitely be good for the region's prospects. Then it's getting a sense of how much of the production capacity will need to be repaired and what realistic timeframes and what the costs of that are likely to be. But for confidence to really come back, we will need to assess all of the resources that can be deployed to be put to work. And that's going to be much more of a lengthy exercise.
Natasha, let me bring you in at this point. The REO baseline, assuming that energy production and trade normalizes relatively quickly. From where you sit, how realistic does that look? How long will it take for energy markets to return to pre-conflict conditions? And we're talking here about volumes and prices, if they ever return there.
Well, yes. So a couple of timelines that we're looking at. So the moment there's a ceasefire announcement, and the market is not waiting for a pronouncement that there is a ceasefire. What the market needs, it's a confirmation from both sides. Not only that, they want a confirmation of security guarantees, whether it's United Nations Security Council that guarantees that indeed there is a true ceasefire. So going from there, the timelines we're looking at, we do believe that it will take about 2 months for the ports to fully normalize. So what we're looking at is that the decision has to be made on the level of 4 different entities. So number one, the ports. Are we open? Are we not? Is it safe? Is it not? Number 2, it's on the level of the owners of the tankers, of the dry bulk ships, the containers, and so on. So do we feel comfortable getting back in the Persian Gulf? Is it open for business? Number 3, it's on the level of the pilot. Yes, the captain of the boat. Do I feel comfortable? Do I feel safe getting back? And the final one is on the level of the seafarers. Those are the sailors that actually, the crew of the boat. Our understanding is that this is the one that is the most important and that will take the longest time, because the Seafarer Union at the very beginning of the war said that this is not a conflict. This is an active war zone. And because of that, they disadvise their union members to be in the region. So in general, we do believe that it will take about 2 months for the ports to fully normalize to the normal traffic, pre-war traffic. So second level is on the level of the operations. We do believe that it will take about 4 months for the operations to normalize to about 99% of the pre-war levels. 3 countries we're watching very closely: Iraq, Kuwait, and Qatar. Older fields, lower pressure, a bigger water cut there. So this is the one that will take the longer. For example, UAE and Saudi Arabia, it will be almost immediate recovery. We also believe that actually the countries will be incentivized to operate at higher utilization rate than prior to the conflict, the moment everything is reopened. And the final data point we're watching very closely is that there appears to be a substantial level of damage. We would have to say that we have a very limited amount of information how much of a damage is actually done to the infrastructure. At least on our side, we're counting about 61 different facilities that have been damaged or severely damaged. But very, very limited information, the extent of that. So that could take days, months, years. So Qatar has been forthcoming, so 3 to 5 years it will take time. But at the same time, we have example of Russia and the Ukrainian drone attacks on the Russian energy infrastructure. They recovered very quickly. So we're not sure that this is applicable to this situation or not. But those are the 3 timelines we're watching closely.
Thank you very much indeed. And those who are tuned into this webinar, please do send your questions in, and we'll get to those in a few minutes' time. Nasser, let me bring you in. I just wonder whether you want to reflect on anything that's been said so far. And if you can just give us a sort of, medium to longer term sort of lens. It does appear increasingly obvious that these MENA economies are likely to be operating under the shadow of more persistent geopolitical risk. I wonder what that implies to your mind about the economic model for this region going forward.
I think, Becky, it's good to put it in a wider context. This is totally unprecedented and unexpected. Nobody anticipated a shock like this, multiple shocks like these. And I think the wider context is to remind ourselves that this is also a period where we've had the greatest economic fragmentation. We're living deglobalization, trade and policy uncertainty, geo-economic political risk is at the height. Liberation Day, April 2025, launched something which we now call economic statecraft, where you're putting your own interests above everything else. We forgot about the rule of law and all the rest. So I think that's an important context in which decision makers in the Gulf and the region are going to have to think. So all these risks have been heightened by the war. And I think there's several points. I think the first one is to focus on the damage. You're going to have to rebuild infrastructure. And that means not only energy infrastructure, but also water infrastructure and things like desalination. I'll come back to that maybe a bit later. But I think a major point here is that we need to think about what are we going to do about infrastructure and rebuilding and reconstruction. And it's much wider than just the Gulf. Do I need to remind us all that many countries in the region have been destroyed? Syria, Iraq, Lebanon, Palestine, Libya, Yemen, Sudan, and the list goes on. My estimate of the cost of reconstruction and redevelopment is close to $2 trillion. How are we going to do that, and where is that going to come from? I believe in institutions and building institutions. And for that, I think we now need a Middle East Bank for Reconstruction and Development. And I think this should be led by the GCC. They have a direct interest in doing so. They have the ability to do so. So to rebuild infrastructure. Number two, you need new trade corridors, land-based trade corridors, road, rail, etc. And you need new pipelines going east to west, such as the Saudi pipeline. But you need to do more than that, because that could be affected as well by war. So you need to think about pipelines that go up through Iraq, into Syria, into Lebanon, and maybe Turkey, and into the Mediterranean. So in many ways, we're going to rediscover our own past because those pipelines got destroyed through previous conflicts. So I think that is a major thing on the agenda for everybody. But a related point, I think, is that we need to be conscious of the fact that the world has changed. What I mean by that is that we have a shift in economic geography towards the east and Asia and China, and we have a shift in economic geography from the Mediterranean. I mean, I'm working at the MENA, right? There's been a shift in economic geography from the Mediterranean down to the GCC. What does that mean? Let's look at the implications of what you want to do to move ahead. It means that you need to start focusing on increased regionalized globalization. What I mean by that is that the GCC countries have got to integrate the other countries of the region into their trade and economies. That means that you're going to have to think of new trade agreements. The UAE has been promoting CEPAs very successfully, but I think we need to go beyond that to have a proper GCC common market, proper union, etc. And I think that then the next point is to say, what do we do about the shift eastwards towards China? We've been negotiating a free trade agreement with China since 2004. It's nearly all agreed. I think this is the time at which to rethink your alliances and say to yourself, I need to put that in place. I need a reliable partner, which is China. So I think we need to build some new institutions in there, free trade agreements, CEPAs, and the like. But you also need new international financial architecture to put in place. So the bottom line, I think, I'm a strong believer in putting in place institutions. Jihad pointed to the fact that the GCC countries, in particular the UAE, has been very proactive in terms of policies, monetary, fiscal, administration, and the like. I think we need to go beyond that towards structural changes. And I think we need to rethink our institutions. There's an Arab Monetary Fund. I think it needs to become much more agile. The Arab League was invented a long time ago. It has to be repurposed to fit the region. The GCC Secretariat has to rethink its objectives given what we've seen as a result of war.
Nasser, thank you. I mean, and you know, much of what you've just been posing here, I hear as a narrative around the region. We do hear about the rethinking of alliances. We also hear about the importance of perhaps further integration in the GCC, or do we believe we will actually see further fragmentation of the GCC? And I think that's a really important point at this point. Sorry, go on.
Agreed. But when you get a shock of this type, you re-question your old alliances and the structure of what you're living through. And if there's anything, is that this is a common shock to all the GCC. If you want to put in place regional infrastructure, you need to agree that, right? If you want pipelines, roads, railroads, and all the rest, that means agreement. That means reviving GCC common institutions. So I think a shock like this is beneficial in forcing you to start to think differently. So at least on that, I think I'm optimistic.
Yeah, well, I mean, it's good to hear that you're optimistic. I'm not sure that everybody I speak to around this region is, but your points are very well made. Thank you. Jihad, let me bring you in. I just want to get your reflections on what you've heard so far. And you talked about your key priorities in your presentation. Do you think these resonate with policymakers around the region? I mean, what are the toughest decisions that they are having to make right now?
Last week, we had all the ministers of finance and central bank governors from the region. And of course, most of them were concerned about the risk of an extended conflict or fragile ceasefire that will keep the Strait of Hormuz unsettled. I think this is the major issue for them today. The uncertainty is also another issue because they don't know if they need to manage a crisis of 3 weeks, 3 months, or even more. And they have already, in certain number of countries, deployed the playbook. Some of it was deployed during the COVID crisis, especially in the GCC. They were able to reconnect or connect very quickly in terms of infrastructure in order to reduce some of the bottlenecks. But I would say there are 3 important issues today. One is to restore, repair, and reconnect. Restore the infrastructure, repair some of the damages that are made, including the scarring, and reconnect, especially to the main partners, which are Asia. And also, I would add another dimension, which is to rethink the future. 50 days ago, the region was promised for a higher level of growth in 2026. The GCC were confirming themselves as not only a safe haven, but also one of the pioneers for the new economies. Therefore, this agenda has to come back. It will come back differently, of course. It will have another dimension, which is called resilience. It will add to it also the geography, how to strengthen geographical links. But this will come. The last issue I think that is important to see, and several have mentioned, is this war has revealed certain number of spots that need to be fixed, including in terms of how to diversify connections and also how to reduce reliance on one source of infrastructure. I think this is going to be what decision makers are currently preparing, planning, but maybe not doing. But the main important issue today, Becky, as we all know, is we need to have clarity on the settlement. We need to have trade routes that are open, unequivocally free. Those are important issues for investors to get more stability and more confidence. When it comes to policies, the situation is different between countries. Those who have already credibility in their policies, diversified their revenues, like in the GCC, they have been able to address the liquidity shock through financial sector measures. They have been able also to restore the doing business, and we see some sectors are now back in business. But for the rest, the question becomes even more challenging going forward, especially if we have entrenched inflation.
Thank you, Jihad. Natasha, let me bring you back in. I wonder whether you agree that one of the lessons from this war is that oil importing countries, of course, are going to need to, really think about sort of not just resilience, but, think in a more sort of resourceful way about how they will weather supply shocks today and going forward. To what extent do you think this will happen through investment in renewables as opposed to changes in oil and gas inventories and or the diversification in supply sources? There's quite a lot in that, but I wonder if you just want to take it on.
Yes, I think it's fair to say that a lot of countries, especially in Southeast Asia, but I think Europe as well, will take a closer look again at China playbook. The country, I think the red line for the country was 2018 and the first layer of export restrictions on semiconductors. And so that was a wake-up moment for China. And so if you take a look what happened after that, it's the 14th five-year plan, the 15th five-year plan currently that we're taking a closer look at. Everything was about entrenchment. Everything was about circular economy and self-sufficiency and independence. So what China decided at that time is, listen, we have weaknesses. So, for example, China is supply insecure. Yes, so they have a lot of coal, but they don't have much anything else. So 70% of their oil is imported. 80% of that goes through the Strait of Malacca, talking about choke points. And so the country did a couple of things. So number one, they diversified their power stack. Yeah. So if you take a look today, more than 50% of their power stack is renewables. But at the same time, they're not married to one particular technology. So they do everything. Yes. So you have coal, you have oil, you have gas, you have nuclear, a very big push in the 15th five-year plan on the nuclear, but also you have, solar, you have wind, and you have other sources of energy, very, very diversified. Number two, as you absolutely pointed out correctly, Becky, it's sources of supply. Not one single country accounts for more than 20% of their import basket. So we've noticed that Russia a couple of times, broke this 20% level in oil, and immediately the next month they were brought back. Only one country's exception is Chile and copper, so they allow more than 20%. That's why they're building the second Power of Siberia 2 gas pipeline, because Russia is below 20% in gas, but they are not building the second ESPO pipeline in oil. So, and number three is stockpiling, Becky, as you absolutely correctly pointed out. China actually used United States as a blueprint in terms of how much storage capacity we have. They did that, and so they massively expanded their oil storage capacity. They increased their gas storage capacity sixfold between 2016 and 2022. They're doubling that now, and by 2030, they'll have exactly what we have in the United States, about 16% of their peak oil demand storage to be able to store that. But not only that, they're filling it up. So if you take a look, 85% of all the global copper right now is actually sitting in China. So 80% of corn, 60% of soybeans, 30% of aluminum, oil as well. So they are really, really filling it up. They have clearly the fiscal space to do that. So I think a lot of countries will take a very, very close look at this blueprint. A lot of questions we're receiving about stockpiling. That's expensive, so we need to keep that in mind, especially for smaller countries in Southeast Asia like Pakistan, Bangladesh, Sri Lanka, Indonesia. So do you have the fiscal space to do that? But a lot of questions we're also receiving, as Nasser absolutely correctly pointed out, it's about bypass capacity. So should Saudi Arabia and UAE expand their pipelines, the existing pipelines? Should Iraq build a pipeline that completely bypasses the Strait of Hormuz, those are expensive. So some of the numbers we're looking at, especially in the case of Iraq, it's up to $40 billion in capex. This is expensive outlay. So a lot of questions about that as well.
Yeah, that's going to be really fascinating. Razia, the REO, as set out by Jihad just earlier, flags confidence, capital flows and borrowing costs as key risks from this war. What are you watching most closely in these regional financial markets and economies to better assess the risks for the region?
Well, that's a good question. And one of the features that really stands out since the onset of this crisis is how limited a widening in sovereign spreads that we've seen. We know ratings agencies have sounded a note of caution, especially on what they perceive to be some of the weaker credits in the region. But on the whole, it's a fair assessment that spreads have been very well behaved, not just for the MENAP region, it has to be said, but perhaps globally for emerging and frontier markets, given the scale of the crisis. Now, a very important point to monitor going forward is whether these very supportive financial conditions remain in place. The strength of the market rallies that we've seen in the recent past, the optimism that everything will soon be resolved, weighed against the real economy impact of this crisis, the disruption to energy supply that may take a few months longer still to try to resolve even under a best case scenario, the potential shortages, the demand destruction that we might see globally, the impact on global growth, and not least, of course, the impact on inflation, which could be much more drawn out than markets are currently pricing in. So all of this suggests, Becky, that we may have seen only a modest widening in spreads the world over, really, up until now. But the real shock, the deeper real economy shock, still needs to be reckoned with. And that could be more long drawn out.
So are you saying that markets, agencies to a degree as well, are misstating or misunderstanding the extent of this crisis?
There are reasonable grounds to suggest that that might be the case. If we look at how markets have clung to the more optimistic scenarios, how there really hasn't been any deep pricing in of the real economy effects and the potentially long drawn out effects of this crisis, there's still reason to be concerned that maybe financial conditions may not remain as accommodative as they have been to date.
Before I just move on, I just wonder, do the more advanced economies of the Gulf, like Saudi and the UAE, have sufficiently deep capital markets and reserves, to your mind, to absorb this market stress?
Well, that's certainly the assessment. Now, we know that there are going to be vast differences between the different sovereigns in terms of the amount of liquidity that can be deployed, the speed with which it can be deployed. But a fair enough assessment of the entire region is, let's not forget the considerable accumulation of wealth that we've seen over the years. The buffers are strong, and I think that that point still stands. Markets, of course, will be concerned about any near-term developments. For now, there's been a sense of comfort that some of the output losses, some of the production foregone will be compensated for by higher oil prices. If that turns out not to be a credible assessment, there could be more financing pressures for some sovereigns than for others, those that are seen to be in greater need of more immediate liquidity. So it's probably fair to say that despite the very modest tightening of financial conditions that we've seen so far, let's wait to see what still emerges. But on the whole, for the region itself, the key point, strong external buffers, strong fiscal buffers as well, I think for the major economies, that remains in place.
Thank you, Jihad. Let me bring you in. A question from Doha Abdul Moniem. I hope I pronounced that right. Al-Ahram. As the Strait of Hormuz is in the center of the conflict, how do the related negative developments, how can or will the related negative developments affect the region's macroeconomic performances, and very specifically they are interested in Egypt's economy. And you spoke to the Egyptian economy a number of times in your REO update. So I wondered if you just want to take that question on.
Thank you, Becky. To the question of dua, of course, the crisis is affecting countries in different ways. And therefore, there is no MENA as we speak. In the past, we used to divide it between oil exporter and oil importer. This asymmetric shock has differentiated impact on countries. Of course, for the oil exporting is the capacity to export, the damage to the infrastructure and access to market that will determine the growth projections for this year. For the oil importing countries is impact on certain number of activities, trade tourism, increase in prices, and also the impact on the access to financial markets. Regarding Egypt, Egypt has been responding quickly to the shock by deploying a set of measures that reduce the impact of the external shock, using exchange rate policy that allowed the economy to buffer part of the external shock. We saw widening of spreads that recovered since, and we are now close to where spreads were before the shock. Growth will be impacted. So far, impact will be limited. And as far as policies, wise set of policies on the fiscal side to reduce the impact while not resorting to the traditional measures, but also on the financial sector side is to preserve the monetary policy approach that works on reducing inflation.
And I wonder how worried you believe MENAP central banks should be about today's energy disruptions turning into persistent inflation problems.
Well, of course, this is the big issue, and this is the challenge for all central banks. What is important at this stage for central banks is to have clear communication about their monetary policy settings. This is a key element in their approach today. Countries where inflation is high or they have accommodative stance, they may need to raise interest rates in order to preserve price stabilities. Countries where exchange rates are flexible, they should use them and let them move as a way to absorb the shock. And countries where they have fixed exchange rate, they should set policy rates and maintain the peg and also preserve their level of reserves. On the other hand, both cases, a clear communication with the financial sector will be very important in order to preserve the financial sector stability at this stage.
Thank you, Jihad. Kaiser Sata, perhaps a question for you, Nasser. The world is not going to be operating in the same way as in the past. What do you think is going to change, and how does it impact the overall price and growth levels in the world, and which countries are the beneficiaries and which will be most affected in this new world order?
Oh, let me bring it back to our region. That's a very wide question. So let me bring it back to our region to come back to where we are and what we should be doing about it. I think if you look ahead, one issue is what you're going to do about economic diversification. What we've seen, if you look across the region, is the countries that are the most diversified tend to have fewer shocks and tend to sustain them better. They come out of it in an easier fashion. So I think one point is to reinforce the fact that we should continue economic diversification, particularly for the GCC countries. That means trade diversification, economic diversification, non-oil sector and the like, as well as government revenue diversification. If you look at Kuwait, got hit badly more than others and downgrade in terms of growth, primarily because it doesn't have any revenues practically apart from oil. You need to diversify. You look, on the other hand, at UAE, you've got now VAT, you've got corporate income taxes, so much more diversified. You absorb the shocks better. I think one item on the agenda is industrial policy. What I mean by that is that just like you have social safety net, you now need to think about business safety nets. And that, to my mind, means using industrial policy much more interesting way to move forward. So you complement monetary, fiscal, and other through industrial policy. And that, to me, means that you need to cooperate together, because what you care about is supply chains and the distortions and disruptions that happen to supply chains. We've talked about the energy shocks and trade shocks and all the rest, but why they really matter is because they disrupt supply chains. So I think one of the ideas, and I come back to institutions, we should have a Gulf Economic Security Council, set in place so you can coordinate some of these policies together. Second thing that we need to think of is what are we going to do about defense, right? I think you're going to see a ramp up of defense spending. And the primary reason for that is that the nature of defense and military spending is changing. We are no longer using the same technologies. So as we move forward, AI, autonomous vehicles, drones, and all the rest will mean you're going to have to spend a lot more. The question is, will that come at the expense of economic development and social, or do we use it wisely in terms of industrial policy? And here again, I think it is time for us to own our own security. We should set up a Gulf Security Council. Should have been set up a long time ago. I think this is the time maybe for that. And the final thing, I think, which is critical, is we've discovered that energy, water, desalination, and digital infrastructure are now security assets. If you hit power, you hit desalination. We're highly dependent on desalination for our water, and it hits all our digital infrastructure, which is important for the digital economy and moving forward. So I think now the nature of what our priorities from an economic point of view will be changing as we move along. So diversify your infrastructure in terms of transport, focus much more on renewable energy, because that can be decentralized and move forward in terms of greater regional integration.
While I've got you here, Ala Shaheen from Shark Bloomberg, a columnist there, question to you on the $2 trillion cost of reconstruction that you estimated a little bit earlier on. Does this include damage from the current war in the GCC? I also assume it excludes Iran.
It excludes Iran and the current damage, because we don't know what the current damage is. I've seen various estimates going anywhere from 35 billion to 50 billion, but I think it's very early to judge what the estimates are of infrastructure damage and the cost of rebuilding.
Question on Saudi Arabia, Jihad, and any of you, I think I'd like to get your sense from all of you on this. Hala Sagbini from Ashaq Al-Awsat newspaper. The IMF recently adjusted growth forecasts for the region due to geopolitical volatility. Given Saudi Arabia's massive commitment to Vision 2030 giga projects, how does the fund assess the kingdom's fiscal space to maintain this investment pace if regional trade disruptions persist and impact oil revenues longer than expected? We did, of course, hear from Yasser Ramayan recently, Jihad, on the sort of, how the fund is refocusing, and, we've got more of a sense about what the strategy for the fund will be across the sort of domestic Saudi space, and what those investments and priorities might look like going forward. What do you make of what we're hearing?
Well, on the fiscal side, Saudi has worked over the last few years to diversify fiscal, developing new source of income, new source of revenues, strengthening fiscal institution, anchor fiscal policy in the medium term. Therefore, on that aspect, already a certain number of measures were taken, and they go in the right direction. In terms of economic management, already we saw prior to the war a certain reprioritization of projects in order to serve the main purpose of the Vision 2030, which is diversify the economy, create jobs, increase productivity, and also improve access to finance, access to markets, access to talents. I think the reprioritization is a normal exercise that happens whenever you have a long-term investment plan and conditions change. I would say, and going back to some of the questions that people are asking today, there is a time for addressing the issues of today and time of thinking the opportunities of tomorrow. What is important today is to restore access to trade routes, reduce the impact of the damage and scarring, and at the same time, planning how the new growth model of the region will be. It will be different. Part of it will remain, part of it will be new, but this will hinge on the stability of the exit from this conflict. I think at this stage, what we have learned as key lessons, that cooperation matters, and this is something that GCC countries are benefiting from. Deepening it will be good for everyone. Two, that geography is also important, and addressing some of the challenges in terms of multiplying access to geographies is important. I think after the various shocks we saw in the last 5 years, COVID, war in Ukraine, all what we saw is showing that geoeconomic fragmentation is a reality that you need to deal with and you need to bypass, but you cannot ignore. Three, what is going to be also very important is to reconnect very quickly to the agenda of the future that several of those countries have been working on and have been working on heavily, maybe now, of thinking strategically, because their main economic partners are in Asia. Therefore, they need to see how they can, even in this agenda, see how they can increase their partnership with countries that are the main destinations of their exports.
That feels like a sort of closing comments there, and we are very close to the end of this. We've got a couple of minutes just left. I just want to open the floor. I do have a question for Razia. Jafar Raza is the Deputy Treasurer for CM PAC Limited. And Razia, this is for you, because I just want to sort of, get back to the fact that all eyes, of course, are on Islamabad and Pakistan. We don't know what will happen in what very much feels like a sort of knife edge next 24, 48 hours. The question from Jafar Raza is, if the end of the war does take place, and that is around these talks, and the most optimistic sources are telling me that, we could have something by the end of the week. That feels enormously optimistic for me, but maybe that is the case. The question here is, how does Pakistan come out of this? What sort of impact might this all have on the Pakistani economy?
Well, that's a really good question. And in the short term, unfortunately, there's no getting away from the impact of the energy price shock. That has been severe. We will see this play out on Pakistan's economy, as with many other economies in Asia as well. But longer term, looking to the strategic tilt of the Gulf region, looking to the strengthening of defense cooperation, Pakistan does stand to gain. We know that it has had close relations with China. We know that as the infrastructure developments have been very closely calibrated with this rising need, where the energy demand is coming from. And so there is something of a structural positive long term. Just to pick on one of Jihad's points that I think is really important for us to focus on, as the Gulf region itself rebuilds itself, as it thinks of where to deploy its fiscal resources, as it looks at closer regional integration, as it looks at cooperation with other trading partners, all of these could be potentially a very strong source of stimulus for growth going forward. If there's one thing that distinguishes this region, it's the ability to reinvent itself. We've seen the seizing of the reform momentum in the recent past, stronger in some economies than in others, to be fair, but it provides a great model for rethinking the post-conflict, the aftermath of the conflict, and how to rebuild in a more resilient way.
And with that, I'm going to close it out. We are at the top of the hour. Donald Trump is due to speak to CNBC half an hour or so from now, just before the markets open. We'll see how what he says affects these markets today. This Tuesday, some 24 hours out from a ceasefire deadline, somewhat extended by Donald Trump, but he says today there will be no further extension. This hour, there is a great deal of uncertainty about what happens next. All of us will be keenly watching that Islamabad meeting, I'm sure, for when those delegations arrive. Let's hope they do, and let's hope we get some progress. To all of you, thank you very much indeed. It's been an absolute honour for me to have moderated this event. IMF.org is where you can find the recorded session. Thank you.
Thank you.
Thank you.